So our first session is going to focus on the multifamily market outlook. We're going to hear from an industry expert, Jay Parsons from RealPage. But before we hear from Jay, I'd like to introduce Yonatan Dotan. So Yonatan was named CEO of Metonic in May of this year. He's responsible for our operations and strategic business initiatives. Yonatan's participated in over $3 billion of real estate transactions, including the development, acquisition, and disposition of multifamily, office, retail, and student housing properties. Yonatan grew up here in Omaha, received his bachelor's degree from the University of Wisconsin. He's a member of YPO, Nebraska, and has a wealth of knowledge in real estate. Please let me welcome Yonatan.
Thank you, Josh. And again, really appreciate all the work that our Metonic team has done to put this together. And thank you all for joining us today. I'm really excited to get the pleasure to introduce and have a conversation with Jay Parsons. Jay serves as the Senior Vice President and Chief Economist for RealPage, leading the economist and industry principal teams to provide insights on market trends and consumer behaviors. He's a frequent author and speaker on topics affecting multifamily apartments and single-family rentals, including rental housing investment and asset management strategy, rental housing policy issues, risk mitigation, and property management. Jay has been cited in practically every business news outlet and has appeared on CNBC and Bloomberg TV. Our team at Metonic follows pretty much everything he writes and says pretty closely. And our organization uses RealPage pretty much throughout. So we're super excited to have Jay with us here today. And just get a chance to learn from him. So Jay, thank you for joining us.
Well, good morning, and thank you for having me today, and appreciate the opportunity to have this conversation.
Everybody can hear okay? Thank you.
How's that?
So I thought we would start with just kind of having a high-level discussion around the current real estate market. I think it's been a volatile year, and across the economy, but specifically, I thought it'd be helpful to just hear your perspective on the real estate market and specifically multifamily.
Yeah, well, at a high level, and I know we'll talk a little about the Midwest as well, but what's happening in most of the country is a little bit different from what's happening here. In multifamily, we are seeing the biggest supply wave that's hit the industry in 50 plus years. We're building a lot of apartments. And there's more than 1 million units under construction right now. Most of that started in 21 and 22, slowed down this year because of high interest rates and just a lot of supply in the market. What we're seeing is there's still good demand for rentals out there. There's great demand for rentals. I think it's kind of a normalizing demand year after some really volatile years since COVID. But the volume of supply hitting the market is in especially the south region of the country, the west of the country, that's pulled down overall rents across the country. So it's really interesting. We're in this cycle where the narrative right now is, hey, there's an article in the Wall Street Journal yesterday saying that renting has never been more affordable than ever relative to buying. And so, but that doesn't necessarily directly, create a lot more rental demand. I mean, people have to remember that, homeowners aren't created out of thin air. Most of them are coming out of rentals when they do. And so you have these kind of mixed factors where overall the market is in good shape in terms of demand fundamentals, but there's just a lot of supply. But I will say again that the Midwest is a little bit different from that. So we're seeing some, I'll probably get more to this in a minute, but we're seeing some kind of a different pattern here than the rest of the country.
Yeah. So I think a big, factor over the last 12 months has been the rise in interest rates. We do have a debt panel coming up that, we'll talk a lot about that, but curious around just what you've seen and the impact of those interest rate increases across the industry, both probably from a rent versus buy for actual consumers to developers, and how that's impacting kind of the whole scale.
Yeah. So I think on the rent versus buy equation, again, I don't think it's been a big driver, but it is keeping up with the rental market. Whether they're but if you're ultimately, I think the single family versus home versus apartment is mostly a life stage decision, right? I mean, if you want to go buy a house and you're married and about to have the first kid and you can't buy a house, you're probably going to rent a single family home. But certainly, I think it's a bigger factor on the acquisition and construction markets. I mean, we've seen, just apartments have just dramatically changed over the last 12 months as rates rose. I mean, we had 2022 and 21 were record sales for apartments, and now it's gotten to the point where we're going to have the slowest year for apartment sales in probably 14 years. And a lot of this is due to the cost of debt and the desire for apartment buildings across the country. We're really seeing this. Apartments are the golden asset class in commercial real estate. Now, here's a good stat for you. 15 years ago, apartment sales were half of office sales in the U.S. And today it's completely flipped. And obviously COVID accelerated that. But we've seen investors love multifamily. Yes, there's still a lot of demand for these assets, and that's keeping prices still pretty elevated. They've not come down as much as people might have thought so far, with interest rates going up, the cost of debt going up. But that is creating challenges for pockets. I mean, there's groups out there that bought a lot of apartments these last couple of years with short-term floating rate debt. Some of them you've probably seen in the news. And so there's going to be pockets of distress. It's created by folks who they bought good real estate, but they were banking on interest rates remaining low. And when all of a sudden you had a 2-year floating rate debt that's come due, you're going to have trouble cover the debt service, and so that's going to create some pockets of distress next year.
So you kind of mentioned the reduction in transactions, right, or the past year. So 14-year low. What do you think changes that? How do you think that reverts back or picks back up?
Yeah, obviously, I think everybody wants to see rates go down, but I think at this point the higher for longer camp is winning out. But I think what's also going to change next year is I don't think it'll affect 21, 22, but those groups that that did buy at the peak prices with short-term floating rate debt, a lot of them are in, and it's important to know, like, there's real distress in the market, but most apartment owners are long-term owners. It's kind of like you hear the homeowners, same story. It's like if you locked in at a 3% mortgage, you're fine. Yeah, you're not really impacted by this, and most of the most multifamily investors as well are long-term owners, and so the sector as a whole is pretty good shape. But there is a pocket of distress we've seen over the last few years as emergence of debt funds and other groups that were offering the short-term floating rate options, and so that group, I think we're going to see some of that end up on the market next year, and I think that'll lead to more transactions where there's they've worked with lenders as long as they can, and they don't really have a way out, and I think that stuff's going to ultimately trigger more sales next year.
So let's talk a little bit more about distress, because I think we've all kind of been waiting for the opportunities to start arising, and from our perspective, I think we haven't quite seen that quite yet. So do you think there are specific areas with outsized distress or areas that we should be paying attention to?
Yeah, no, it's interesting. I've had the opportunity to do a similar events like this in many parts of the country, and I think there's a lot of groups out there that love apartments, and they're just waiting for a lot of this distress at the market, and it's just not happening quite yet. Again, I do think we'll see more of it next year. I don't think it'll be in the volumes that a lot of investors want to see, but it'll happen. In terms of where it'll be, I think it's going to have more to do with where we saw. It's not so much about weaker markets so much as it is about where we saw higher concentrations of investors who were relatively new investors who were buying on with the short-term short-term opportunity. So a lot of that was really concentrated in the Sun Belt. But again, you're going to see opportunities like everywhere in the country, and I think it's especially going to be the case for you're going to have lease-ups, new construction, where the developer is no longer able to refinance permanent debt as easily as they wanted to. That's going to be an opportunity, and that's going to be all over the country. And then I think you're also going to see opportunities in what we call the B and C market, which are generally your kind of older apartments, where you had investors who bought, planning to do big renovations, value add programs, and then all of a sudden, they put in some capital costs to do some renovations of the project, but they're not able to get the 20% lift in rents that they expected, and so all of a sudden, they're challenged a bit as well. So I think those are the two things we'll see, and while you may see more of it in the Sun Belt as a reflection of that's where so much of the activity was in this last cycle, I think you're going to see it in the Midwest, and there are pockets of it in the Midwest all over the country, really.
So you brought up the different Class A, Class B, Class C segments of multifamily. And you recently put out an article about the gap between Class A and Class B kind of being a lot tighter than it has been historically. And I think you'd even said something about, you had made a prediction and we're a little bit off base. So I'd love to hear kind of your thoughts around that and why you think that gap exists there today.
Yeah, so being in the prediction business is tough because it's you're often going to be proven wrong, and so we want to admit when that happens. And what he referenced is going to this year. Our view was that we would see better demand for apartments this year, but that we would see the market soften primarily in the Class A space, which is mostly higher income renters living in newer apartments, and that's the segment that's most impacted by new construction. But what's happened is the Class B market, which we call like the middle market. These are middle and middle upper income renters. They're generally not financially stretched. Most of them are paying around 23% of income toward rent, gross income toward rent. And then importantly, the rent differential nationally was something like 25% difference to move into a Class A property. And so that's a big jump, right? But what's happened is we're seeing is in these areas where there's a lot of apartment construction, the Class B market has been impacted much, much more than we expected. And some of this is kind of, I think, reflecting the strength of the renter base. I think a lot of our, this is a brief aside, we commissioned a national study earlier this year of apartment renters. And one of the things that really jumped out of the study, and this was by legit research group, it wasn't like a Survey Monkey poll or something like that. And one of the things that came out from it is that renters felt strongly there's misconceptions about who they are and why they rent. 2/3 of renters are renting for reasons other than not being able to afford to buy a house. Something like 3 and 4 said that we have a culture that views them more negatively than people view homeowners. And so there's this perception, especially apartment renters, that they're just people who can't afford to buy, and so that's why they're renting. But we've seen in the data that people who are renting market rate apartments have fared really well these last few years, and they're in pretty good shape, and most of them are renting by choice. And so long story short, I think what's happening is that all this new construction is hitting the market. A lot of it's being discounted. You may drive by somewhere and you see like 2 months free, 3 months free. Well, that's 2 months free essentially is a 60% discount on rent for the first year. And so all of a sudden, like that gap between, your middle income rents and then your brand new construction, maybe it's now an 8% jump. Well, you know what? I'm paying 20% income on rent. My income's gone up the last few years. I'm going to pay a little more, but you know what? That brand new property in that better location, that looks pretty good, right? Better amenities, newer units, nicer finish out, all that type of stuff. And so you have not everybody, but you have a contingent of the renter base that can't afford that. Maybe there's been some pent up demand for that. And now they're being lured up market into that segment of the market. So again, it's primarily happening in areas where there's tons and tons of construction. It's not happening as much in the Midwest because there's not as much construction, but it has been, I think, the biggest surprise to me this year.
Yeah. So kind of on the same vein as construction and new supply, we obviously talked about the impact of interest rates on developers, but I think the other, really big challenge that we've had, and this isn't necessarily new to the last 12 months, but really since the pandemic, is construction costs continuing to rise. So, do you feel like that is, I'm not asking you to look into a crystal ball or anything, but do you think that there's any softness there? Are you seeing anything like that that's starting to bring back construction costs?
Yeah, thank you for the crystal ball comment. Crystal ball is very fuzzy these days. So, I think construction costs are. I think the best way to put it is they're moderating. They're not unpredictable anymore. A lot of times developers and their capital partners, they just need predictability. They need to know what my costs are going to be, and that's been a challenge these last few years. But now the problem is that, maybe the cost of lumber has come down a little bit. Most of my material costs have been, they've not gotten a lot cheaper in most things. I mean, the cost of construction is kind of like overall inflation for the most consumer. It's like the cost of the pace of increases has come down, but things aren't really getting cheaper, right? So it's the same thing for construction. But the real problem for developers right now is the cost of debt and the availability of construction loans. And so there's been a lot of pressure on banks. Regional banks are the primary construction lenders for apartments. in our industry, Fannie Mae and Freddie Mac together about half of the debt for stabilized existing apartments, but they don't do construction loans. The construction loans come from the regional banks, and so everybody knows, I'm sure here, that the regional banks are under a lot of pressure. A lot of them have have actually really strong performing multifamily portfolios, but they still have a pressure on them to reduce exposure to commercial real estate and especially to construction. So they're limiting how much they do. And even when they do lend, it's typically with preferred partners, groups that already have, existing relationships with those banks. And then on top of that, they're typically requiring lower loan to cost. So it could be, instead of, 65, 70% loan to cost, now it's 50%, which means you got to raise additional equity. Plus your cost of the debt is going to be higher as well. So that's now the bigger challenge for developers, is sorting through that. And I think we're going to enter into a cycle now where we're really going to separate, kind of the groups that are able to work through that and are flexible enough and creative enough and have the partnerships to be opportunistic right now, and the groups that just don't have the capital to work through it. And by the way, one last comment I think that we're going to see is that the groups that there's where starts are down 40 to 50% this year versus last year. And so that means that by 25, 26, there's going to be a lot less supply hitting the market. And so developers who are able to be delivering, especially in 26, I think are going to do really well, but it's going to be very few.
Yep. Well, that's a good segue into kind of my next overall topic that I want to kind of talk through. But last year in our forum, we talked a lot about the housing shortage and how we need more housing. And obviously, we've now talked about a lot of new construction coming into the market, but that's starting to slow. So generally just curious about how you think about the overall housing market, whether you still feel like there's a shortage, whether you feel like the new construction has made up for some of that, and what you think that looks like over the next couple of years as construction, does start to, wind down a little bit, as a lot of groups are pressing the pause button.
Yeah. No, that's a good question. I think it's one that's really misunderstood. A couple of thoughts here is, number one, we are structurally undersupplied of housing. Like, we need more housing, especially at the middle income levels. Most of what gets built for apartments and single family homes is targeting upper income households. I'll give you a crazy stat. Most people I'll ask you a question, I'll answer. Think about this in your head. What do you think the typical income is nationally for somebody living in a brand new apartment building? Household income. So typically there's a room. All right, so household income for somebody living in a brand new apartment building. Just think about that, kids. All right, it's about $112,000. All right, that's double the median income in the U.S. And there's been a lot of demand at that price point, but obviously there's even greater demand the more you move down market. And that's one reason that long term we're still really bullish on the Class B segment. And so I think what we're seeing now is some kind of short. I don't like the word oversupply, because it implies a structural imbalance. I think instead it's a short-term supply-demand imbalance in certain places where we're building much faster than what demand can keep up with. But ultimately, it's very difficult for developers to time supply with demand, and so that's why supply is always very cyclical. And so it's going to be, we have supply levels that are peaking this year and next year in terms of completions. It'll probably exceed demand in the short term, but eventually, supply slows down in 25 and 26, and then demand picks up again. All of a sudden, we have, the headlines shift back. Now, and one last thing I'll say too is, I see a lot of, in the kind of, one of the big debates you hear right now is, that people say, hey, well, population growth is slowing down in the U.S., so therefore we need less housing. Well, I think people really misunderstand the point here. Is, number one, when people argue that, they're assuming that the next generation of renters want to live in the same places and the same units built for their grandparents, which is not going to be the case. And number two, the slowdown in population is really now with young children's age. I mean, look at the change number of 5-year-olds, versus that number is moderating. So it doesn't really impact the apartment market, even the housing market, for 15, 20 years. That's assuming that there's no other solution through things like immigration reform, right? And so for the next 15 to 20 years, that's not a big concern, because 5-year-olds aren't leasing apartments. So the number of young adults is continue to be a driver for needing more.
And thinking about, a lot of this new supply coming into the market, what do you think the time frame is for that supply to be absorbed? And then, what does the back end look like? Because I think right now, nationally, we're starting to see some softness, both from a vacancy standpoint and from a rent growth standpoint. How do you think that plays out here over the next, year or two?
Yeah, I think our view is that next year will be the kind of the bottom point for this cycle. Yeah, this is assuming that the economy remains in pretty decent shape as it's been. Maybe moderating job growth and wage growth, but still pretty solid overall. But that's when supplies, the completions will be peaking kind of middle of next year, and then they start to kind of slowly tick down. And by the time we get to 25, especially the second half of 25, there'll be far fewer units completing. And so I think what we're going to see is that demand will start to catch up with supply in 25. And I think in 2024, we'll continue to see pretty flat rents nationally, maybe in a lot of rent cuts in certain markets and higher vacancy. By the time you get 25, as supply comes down, I think demand should continue to be pretty solid, barring a big shock in the economy. And then I think what we'll see is, I mentioned all those 2 and 3 months free, those will go away. You start to see effective rent growth again. And I think the market is set up to see pretty good years in 25 and 26.
So you mentioned a little bit about the Midwest, and I think what we're seeing right now is just the resiliency of the Midwest compared to the rest of the country. What do you think factors in there? I mean, we've obviously talked a lot about, construction starts, but we're seeing quite a bit of new construction, in Omaha, for example, relative to our historic average. And yet we're still, pretty resilient as far as occupancy and rent growth goes. I think we're actually at the top of the charts for rent growth over the last couple of months. What do you think factors into that?
Yeah, no, a couple of things. I think number one is that while supply is everywhere, it's still more, on a relative basis, still more limited in the Midwest. And it's interesting because, there's definitely construction. And I think, like you said, like you're in a market, we say, hey, like it feels like more than ever. You're right. But, if you go to, places like Huntsville, Alabama, where they're building, they're going to grow the number of apartments. They have 100 that existed previously. They're adding 20 more. And then, across, Austin and Nashville, Charlotte, Raleigh, Phoenix, like these markets are just, they're adding tens of thousands of apartments. And that's why it's been more of a challenge. I think in the Midwest, and there are some exceptions even in the Midwest, and we're seeing crazy construction boom in places like Sioux Falls, which has never seen that kind of a wave. But for most of the Midwest, we're seeing some construction, but I think of manageable volume. Traditionally, Midwest markets are sort of underbuilt, especially the newer construction. Catering to the middle and upper income market. So I think we're at a period of the cycle where the tortoise beats the hare. This is a cycle now where that rewards the slow and steady, and the Midwest has been the slow and steady. It's more predictable, more limited downside, more limited upside. But I think a very there's value in that right now, right? When you're seeing the rest of the we look at, you alluded to this from Omaha, but like nationally. We're tracking 300 plus MSAs across the country. Up the top 20, I think all of them except for maybe one are in the Midwest or the Northeast, which is really unusual. In a lot of Midwest markets, so it's especially secondary markets, smaller markets that are doing really, really well. And I think that's again because there's been great demand, this steady demand in these markets. It continues to come in. While supply, we're building apartments, just not at the levels that we're seeing in other parts of the country. And so I think a lot of these Midwest markets are pretty well positioned through this next cycle as well, and will continue to be outperformers in this couple of years.
Are there specific markets that you're looking at and feel like kind of have an outsized opportunity in the Midwest?
Yeah, well, I'll tell you, just let me start kind of high and go big markets and go down. We're seeing a lot more national interest than ever among even institutional investors who previously ignored the Midwest. Like they're now looking at markets like Columbus and Indianapolis and Kansas City. I think those are the three that are starting to get on the national radar. And then, on the kind of smaller and more regional markets, I look at places, including Omaha and Des Moines that have continued to grow. Madison's a market that's done really, really well, which New York and we've gone on the list, but the markets that I think there's a lot of attractive markets in the Midwest that you still, while these markets continue to perform well, the cap rates here, the pricing is still more favorable relative to these very high supply markets, and also most of these markets you have a pretty favorable regulatory environment as well. So I think you're going to see these markets continue to be pretty.
And as far as institutional capital kind of starting to come into secondary, tertiary markets, What do you think is the primary driver behind that? Is it really kind of the supply-demand fundamentals, or is it something beyond that?
Yeah, well, I think that's part of it. I think they're seeing that the value of having, some diversification in the portfolio. And I'll give you a little, some context. 15 years ago, you think about like the big institutional names. I don't want to name any because I don't want to offend anybody, but like you think about like the big institutional money. They were primarily investing what they call, the sexy six or the coastal core markets, places like New York, Boston, DC, LA, San Francisco, Seattle. Like that's where they wanted to be. They thought that's where that's where all the opportunity was. And ever since really coming out of the great financial crisis, they started to see the emergence of the big Sunbelt markets. So then all of a sudden now, when you look in this past cycle, the most attractive markets to institutional money were places like Dallas and Atlanta, Denver, Austin, Charlotte, like those Houston, those markets really grew in profile. And I think now what they're seeing is, as those markets have done really, really well over the last decade, attracted a lot of construction. And at the same time, the coastal markets have generally not performed as well, and they're under a lot of regulatory pressure in those markets as well. There's a lot of anti-renter bias and NIMBYism in those areas. That's really kind of led to, okay, what's the next place to be? And the concern previously in the Midwest, even the big Midwestern cities of Chicago, had always been liquidity. Like one thing institutional guys always worry about is who am I going to sell to? And that was the same concern about Atlanta and Dallas 15 years ago. And it's kind of been overcome. So I think what we're going to see this next cycle is of saying, hey, you know what, we know that over a 10-year period, our best rent growth is probably not going to be a Midwest market, but it does kind of, it's the most predictable market. We know we're not going to lose money in these places, and we're probably going to get a pretty solid return. It's going to be a good balance from being, the Dallas, Atlanta's, Charlotte's at the same time. So I think you're going to see more and more.
Yeah. So we've obviously talked about interest rates, construction costs. I think, we'd be remiss not to talk about other kind of expense inflationary pressures that have been going on kind of across the economy. But I think specifically what we're seeing a lot of is insurance increases, taxes, things like that impact our properties. What's your general take on what's going on in the world right now?
Yeah, well, and anybody easy when a homeowner, you probably have seen what's going on with insurance rates right now. It's all types of real estate, and it's really impacted commercial real estate and apartments as well, especially in coastal markets like Florida. In Florida, we've seen property insurance premiums over the last 2 years have doubled. So it's just, in some cases, it's killing deals altogether. It's no longer. So we've seen insurance carriers exiting the market altogether, and that's further driven up the cost. And, I'll give you a very unreassuring anecdote here. I was at a couple of industry events recently where these groups had brought in insurance brokers and they said, hey, tell us what's going to go on. We can't do it. That's so unpredictable. And there was almost like this rebellion among the group when the insurance experts have no answer on what's going on and when it's going to get better. And I think it's just it's become really tough with these different series of events. Now, part of it had been the rise of replacement costs. We know construction costs that went higher, land prices went higher. And so the replacement cost factor was one of those drivers, for higher insurance costs. So I think as that is moderated, I think that should be a positive sign. But we're also seeing just so much concern about, hurricanes and power grid issues, natural disasters, that I think that we're seeing insurance companies continue to err on the side of really pushing rates. So that's a huge headache for the industry. especially again in the kind of the Gulf Coast region of the country, especially Florida. I think taxes will get more predictable, and we're seeing, obviously we're seeing prices have stabilized or even gone down in some places. So I think that's going to be more of a tailwind years. But, overall expense inflation has been a real challenge. And again, I think you're going to see some operators this next year where their costs are rising faster in 24 than their revenues. Again, especially in certain markets. So
yeah. So we've obviously been focusing a lot on the current challenges and, the volatility in the economy right now and a lot of the headwinds here. Do you still think that multifamily is a viable investment option for investors today?
Oh, absolutely. And, I'll tell you one thing I think COVID taught us is, hey, You can shop from anywhere, you can work from anywhere, you can order food from anywhere, but you got to have a home. And I think that's such the home is essential. You got to have a home. Everybody needs a home. And so, I'm still very bullish on all forms of housing, especially rental housing, apartments, single-family rentals. Ultimately, I think what we're going to see is, real estate's always been somewhat cyclical, right? Like that's not going to go away. Right now we have more supply than demand in the short term and the national basis, but there's exceptions. You get a lot of those in the Midwest. And then going forward as well is, I think it's very plausible 18, 24 months from now to be in a situation where the narrative is that we're, undersupplied and vacancy is low again and rents are rebounding again. And so, I look at it and, I think about, going back to the great financial crisis, lessons we learned there is, there were so many groups that they kind of said early on, like we're betting on multifamily, and they started, buying when everybody else is sort of still looking for a bottom. And some of those guys are now some of the largest apartment builders in the country. And I think in this next cycle as well, those groups there's a lot of capital that still loves multifamily. I think a lot of investors out there, they want to see some like doomsday scenario before they jump back in. I think those folks are going to be, still holding money at the end of the day. I think what you're going to see is those who, I think we're going to start to see more movement this next year. And as always, people, move faster ultimately do really well, especially I think these next, I think if you could, the industry phrase right now is survive till 25, right? So you have high interest rates, lots of construction. I think if you get past 24, again, I think the groups that survive.
So it's interesting you bring up kind of the last financial crisis. Metonic was really formed in 2011 as we saw an opportunity to deploy capital pretty actively in multifamily. So it took a few years for us to get to that point where, I think the opportunities presented themselves and we started taking advantage. I don't think this feels the same, but what do you think that looks like over the next couple of years? I mean, it sounds like you think there won't necessarily be the same level of opportunities, but we've obviously talked about distress a little bit, which can create opportunities. So how do you kind of look at those from a parallel perspective?
I agree. I don't think this is like a great financial crisis, but I think you have a lot of investors who think it will be, and so therefore they're kind of waiting on the sidelines. I mean, there's been numerous, within the industry, there's been numerous reports recently showing that dry powder is higher than ever for commercial real estate, specifically for apartments. Investors love apartments and investors. And but a lot of it's just waiting for something to happen. But again, I don't think it's probably happen, at least not as severely. And so to answer your question, I think there's going to be opportunity in a few areas. I mean, number one, I think with lease-up distress, I think you're going to see a lot of, and this is new construction, where it's just a financing issue. I think there's going to be a lot of really good real estate that just has issues with its financing. It's essentially just, it's not the building, the location, or even the rents and the occupancy. It's just having to do with all of a sudden the cost of their debt is much higher than they had underwritten, and they don't have a choice but to sell. And in those cases, they're just trying not to lose money. And then on the other side of that too, I think you're going to see more of these, what the industry calls these value add deals that have gone bad. And that's the big renovation programs. And what we saw in this last cycle, one of the most common investment strategies has been, hey, I'm going to buy an apartment built in 70s, 80s, and 90s, do a big renovation program, and then raise the rents 20% after we put all this capital in. And that worked really, really well for a while. But then all of a sudden, people who are buying that were buying with 2 and 3 year floating rate debt. And all of a sudden, as I alluded to earlier, you're in a period where, we're having to refinance, and the cost of capital is much more than we expected. The property is now worth, in some cases, it could be worth less than the loan in most extreme cases. And on top of that, you're not generating the rents that you expected to because of the overall slowdown in the market, which again, that was, it's only because you were assuming 20% rent growth and low interest rates. So if you take away those things, but again, the underlying real estate's still good. It's just that you have a bad structure. So I think that's where we're going to see opportunity.
Yeah. It's interesting because I think a lot of what you're describing really resonates with Metonic and what we do. And Justin is going to be on a panel a little bit later and talk about our investment and acquisition strategy. But, everything that we think about is long duration, fixed rate debt. We're not trying to time the market. We're trying to take advantage of opportunities as we see them. But, really trying to be steady in our approach and not stretching when, when there's volatility in the market that, you see a lot of other sponsors taking, low fixed or floating rate debt and then kind of having challenges in like the current environment. And so I think a lot of the fundamentals that you're talking about really match the way we think about doing deals and the way we think about investing in real estate. And so maybe speak a little bit about like the variety of sponsors that you're seeing and how different sponsors approach multifamily investing and how you're seeing that kind of impact their investments.
First of all, let me say, one thing that, a hot market makes everybody look like a genius, right? I mean, in 21 and 22, you could have had the worst investment strategy, you could have been the worst operator and done phenomenal, right? I mean, it was just, that was, we saw more demand in 2021 for apartments than any year in history. And then rents, for 15%, like, I think that was a generational event. Like, I don't think we're going to see that again anytime we get in my career. I don't think we're going to see 1 million units under construction again anytime in my career. I think these were once in a generation events that, again, made a lot of people look really, really smart. And, they were, so when they got in when they did, but some of it's hard to differentiate being smart and being lucky. I think what we're going to see now is, again, a lot of that investment was really focused on short-term value-add programs. Essentially, it was the multifamily version of flippers. We saw a lot of flippers, and in fact, if y'all see headlines and the business publications about, there's been a few leaked recently about apartment owners that have had problems. You read in through it, there's some commonalities. Typically, newer investment groups, short-term floating rate debt, big value-add programs. Like that again did really well for a while until it didn't. And so I think what you're going to see now is the more patient, and what we already see. I mean, is the more patient capital that's more flexible. Those are the groups that are sitting pretty low right now. And by that, what I mean is, if you can, the groups that are out there are still buying apartments. A lot of them are assuming really no growth in 2024, and they're assuming a rebound in 25 and 26. And then also importantly is they're not tied to a specific, the buyers who are still out there, they're not tied to a certain exit period. They need, everybody wants to see rates come back down, but if you're dependent on that happening in 25, that's different than someone who's, okay, I'm planning a longer term hold, we'll refinance at some point, but it doesn't have to be in 25. Like, those are the groups that are ultimately going to be very well positioned. Again, as I talked about, the long-term tailwinds I think are great. Flexibility is from a financing standpoint, capital standpoint, is really, really important.
So do you think that, a lot of those groups are mostly structured as funds and kind of have specific, fund life durations and have to exit, and that's kind of causing some of those challenges?
Yeah, it's some of that, but I think you also have, you have individual deal investors too that are promising big money, right? And I think some of these investors just don't have a skewed sense of what normal is, and they don't realize, like, that's not what typically, you can't bank on that year after year after year. Like, that's not normal. These last few years have brought so many investors in the multifamily has sort of skewed our sense of what normal really is. Apartments have always been a good asset class, but I think what we're seeing is more, again, a market reversion to what's normal, which is good, solid, predictable returns. But yeah, I think you're going to, whether it's the fund, but also the big short-term value add, deal by deal investments, I think are.
Well, I want to make sure we save some time for questions from the audience here. So I don't know if anybody has anything specific, but feel free to ask questions. I want you to have an opportunity to speak with Jay as well.
So what's going to happen? I mean, I see the bottom of the market, or the lower income, really getting squeezed out. Anything's going to happen?
Yeah, so the question was about the lower end, about being squeezed out. Yeah, so I'll tell you, I think affordability is one of the most complex issues in rental housing. So the truth of it is that it's very bifurcated. And so as you pointed out, it's like there is a real challenge at the very low end of the market, which I would describe as like true low income. All right. And so there's a shortage of low income housing in our country. Recently and this is, by the way, it's just kind of it's a frustrating policy issue because it's one issue that I think both sides of the aisle conceptually agree on. It's a program called the low income housing tax credit. And the Democrats love it because it gives them more affordable housing. The Republicans love it because it actually stimulates the private sector to build it as opposed to the government building it. And so it's this win-win. But it's gotten kind of lumped in with a broader infrastructure bill and never got anywhere. But we need more of this stuff. That's going to reduce pressure on everyone. And we need, that's where the biggest challenges are, is true low-income housing. But what we're seeing is that in the market rate sector, we, through our company, it's like we do, all the lease applications, background checks, things like that. We're still seeing rent income ratios nationally are at 23%. We see rent collections are basically where they were prior to COVID. It's about 95, 96% of rent due gets paid every month. And so nationally, like the key signals are still very, very positive. And so I think what we're seeing is this big bifurcation between those at the very low end who are generally living in subsidized housing. And by the way, we service a lot of affordable housing as well. It's like some of the lowest rent collections. I mean, it's the most rental distress, I should say, rent delinquency is concentrated in low-income affordable housing that essentially is rent control. But it's for that segment of population, their rent is fixed, but their other costs are not. And so we still see distress in that group. We don't see it as much in the market rate sector of the apartment market. And again, I think that the market rate apartment demographic overall has actually fared pretty well. But it's just a complicated story because what you're saying is true, but it's actually not reflective necessarily of what we're seeing in most of the kind of market rate apartments.
Joel, I saw your hand up.
What markets would you avoid?
I would avoid the big coastal cities altogether. It's my money. I would not want to be in New York, LA, San Francisco, and not necessarily because of the, I think demand. Other than San Francisco, demand is pretty good, but it's they're really tough markets to operate in. And some of the lowest rent collections we see are in Los Angeles and New York, which in those cities, paying rent is essentially optional, regardless of your income level. So, I would say that halfway to cheap.
Yeah.
Same thing as what Randy was talking about. How much political risk do you think we have going forward? I know there's about 30 states that have laws against rent control, but if a federal law comes down, like the administration is talking about trying to get rent control, I mean, how much political risk do you think we have there?
Yeah, I think this is I think political risk, policy risk is the biggest headwind for the rental housing industry. Which, by the way, as an aside, I think one thing that doesn't get enough conversation is like everyone's focused on rental affordability, but rent costs grew less than half the rate of home prices over the last few years. And there was an article also yesterday showing that the renting is cheaper than ever relative to buying a house. And so, but I think sometimes the obviously the narrative gets ahead of itself. But yeah, to answer your question, I do think that's a real risk. But most of what the administration has currently discussed is mostly about how they would utilize Fannie Mae, Freddie Mac, the GSEs, and there has been some conversation about essentially politicizing the agencies, which are the primary. You get half the loans came there through the agencies, and perhaps I think the greatest risk there is if there's a rent control mandate for properties that are leveraging Fannie and Freddie debt. That would, I think, permanently make debt more expensive because you would see more demand for, life insurance company debt, bank debt, debt funds, other more creative programs that are out there. So I don't think it would be a national mandate that's more broad. I think it'd be more narrow like that, but it could change the landscape quite a bit. And by the way, it's not just rent control. We were also seeing big challenges, things like resident screening. Screening and background checks, they're really designed to protect the community and new renters. And we're seeing a lot of leasing fraud across the country right now, where people are spending a couple $1,000s for essentially a very sophisticated fake ID, and then not paying the rent or even subleasing that unit to somebody else, and they're taking the rent check but not paying the property manager. So it's a real important issue, I think, ultimately to protect affordability as well. But there's been a lot of pushback not to get some cities.
Yeah.
Do you have any perspective on the Airbnb effect of the recent ban in New York and what we see nationwide?
Yeah, so that's a good example of, I think cities, they're looking to pass blame instead of pass solutions. And this is, there's, as I mentioned earlier, it's like, the more supply, the better. From a policy standpoint, if you really impact affordability, legalize a lot more. And we're seeing that's happening, and we're building a lot. But places like New York is, it's really hard to build. I saw a story the other day about somebody trying to build an affordable housing apartment property in New York City, and the local council, Alderman, whatever they call it, like they rejected this, even though it was all affordable, because they didn't like the shadows it cast on the neighborhood. Like, it was the shadows. Oh, they want the shadows. And it's like, guys, like we're focusing on things. So like the Airbnb thing is a good example as well, where, I saw some data points the other day. It's like, by banning, essentially, really banning Airbnb, how much is that really going to impact the market? Well, the view is, hey, like, this will put more housing on the market. Well, these are relatively small numbers. I think it was, a lot of those units were already longer term rentals anyway, just being leased through Airbnb, but also too is like the total number is really a drop in the bucket. It's not going to move the needle, and it's really just going to make the cost of hotels, short-term stays more expensive in those markets. It's going to do very little for the rental market, the long-term traditional rental market. But I think that's a segment too where, we'll see some policy changes over the coming year. Maybe like more cities, especially try to limit Airbnbs in kind of better communities. But I think people, especially in the Twitter world, do grossly overstate the impact of short-term rentals.
Great. Well, Jay, thank you for being with us. Appreciate you making your first of many trips to Omaha. Just enjoyed the conversation, and thanks for joining us today.
Thanks for having me.